Welcome to part 5 of the Introduction to Futures. In today's class, we will understand what is minimum variance hedge ratio and how it is used to hedge your portfolio. What is minimum variance hedge ratio? Variance is nothing but the volatility of a particular portfolio. So, depending upon the volatility of the portfolio, the amount of hedge which you want to take for the portfolio has to increase and decrease accordingly, because if the portfolio prices are very volatile, then your quantity of hedge will also increase or decrease accordingly. Usually, a normal trader will use a 1:1 hedge ratio. Suppose if he has got a Nifty 50 portfolio, he will hedge the his Nifty 50 portfolio using the equal number of contracts in the futures of Nifty 50. However, the optimal hedge ratio generally differs because there is imperfection between the cash price and the future price. As we have discussed, the basis will always exist. So there will not be a perfect correlation between cash and future prices. There will be very less correlation between the cash and future prices. So whenever the correlation is less, then the hedge ratio will accordingly increase or decrease when the correlation increases or decreases. The minimum variance hedge ratio is calculated using the regression analysis. I am not going to discuss what regression analysis is. I will put a link in the description where you can go and see. I have discussed regression analysis in detail. So you can carry out a regression analysis of historical prices in the spot asset and the futures contract, and this will help you to make a better decision with respect to the minimum variance hedge ratio. It all depends upon the strength of the relationship between the futures contract and spot. See, a relationship between two commodities or two entities is done using the concept called variance. Variance will tell you whether a relationship exists between two commodities or two financial product. Whereas the coefficient of correlation will tell you the strength of the relationship. How strong is the relationship between those two financial entities or any two commodities in which you are trying to find out the correlation. So how do we calculate the MVHR? See, the minimum hedge ratio is derived by minimizing the variance of the hedged portfolio. So how are you going to minimize the variance? The formula is that this is the minimum variance hedge ratio, H star, which is equal to rho. Rho is nothing but the coefficient of correlation. What is coefficient of correlation? Coefficient of correlation is the strength of correlation or relationship between two entities. Here, what are the two entities we are trying to find the strength of the relationship between the spot and the future? Okay. Now, sigma S is nothing but the standard deviation of the spot price, and sigma F is nothing but the standard deviation of the future price. What is standard deviation? Standard deviation is nothing but the deviation from the mean value. Okay. So, the minimum variance hedge ratio is given by the coefficient of correlation between this spot and the future, which will tell you the what is the strength of the relationship between them, whether they are correlated with each other or not. Correlation means whether the price moves in the same direction or if they move in the opposite direction. That is called as correlation. If they are very well correlated, means the price will generally move in the same direction. If they are positively correlated, means they will move in the same direction but not in the same proportion. If they are negatively correlated, means if the spot moves in the positive direction, the future will move in the negative direction. Okay. So this is how this correlation coefficient of correlation means. Now standard deviation is, I have already explained, deviation from the mean. Now coming to the let us take one example of this calculation. Suppose a portfolio manager wants to hedge a stock portfolio using the index futures. So what is the standard deviation of the portfolio? That is the, see, portfolio means spot. Okay. So standard deviation of the portfolio means sigma S spot. So it is 18% annually. It means the deviation from the mean of the prices of this portfolio will be 18% upside or 18% downside. Okay. Now the standard deviation of the index futures, that is sigma F, is 15%. So the deviation is general of the future is less than the deviation of the spot. So since the portfolio has got higher standard deviation than the future, we will have to hedge more. Let us see how this works. So the coefficient of correlation between them is 8.85. It means 85% of the time the future prices will move alongside the spot price, or the spot price move along with the future price. That is called as correlation. So how do we calculate minimum hedge variance hedge ratio? Just plug in the values. 0.85 into 0.18 divided by 0.15. So the optimal hedge ratio is 1.02, meaning the manager should sell index future with notional value approximately 102% of the portfolio value. Let us assume the portfolio value of a portfolio held by a portfolio manager is 50 lakhs. Okay. Now, if he is holding 50 lakh portfolio, how much rupees of short position he should take in the futures? It is 1.102% of it. So he should spend 51 lakh rupees. What? No, that is that amount. 51 lakh rupees amount of short position he should take in the index futures. So as I have explained, the 0.85 correlation indicates that the index futures will capture 85% of the portfolio movements. The 1.02 volatility ratio adjusts for the portfolio's higher volatility. That, as I have already explained, whenever the standard deviation of the portfolio is higher, it means standard deviation means volatility. Okay, you should understand sigma s. As soon as it comes, you have to understand it is volatility. Okay, so the portfolio volatility is higher than the index futures volatility. Hence, the hedge should always be higher than the whatever the value which you are portfolio value which you have taken. Now, the next point is how to calculate the number of contracts, because just by calculating minimum hedge portfolio will not help you in any way. You want the mathematics of it, how much contract you should short in order to, if you are having a particular value of portfolio. Let us see how is it calculated. It is calculated by the formula, the hedge ratio into value of the A, that is whatever portfolio you are holding, and the value of F, what is the value of the future contract. How do we calculate it? Where n is the optimal number of future contract which you are supposed to short, and H is nothing but your optimal hedge ratio. VA is value of the asset position which is being hedged, that is value of the portfolio which you are holding, and VF means value of one futures contract. How do you calculate the value of one future contract? It is nothing but the future price into the contract multiplier. If the future price is, if the future is trading at 22,000 and the contract multiplier is 50, so it is 22,000 into 50. That is going to be the value of the future contract. So this formula will help you to translate the hedge ratio into practical implementation, as I have just explained. This will help you to take how much short positions, how many contracts of short positions which you have to take in order to hedge your portfolio optimally. Let us take an example of this. Let us say a company holds 50 million worth of Nifty stocks and wants to hedge using Nifty futures. The optimal hedge ratio is 1.02, which we have already calculated, and the portfolio value is 50 lakhs, and current Nifty level is 18,000, and Nifty future lot size is 50. So hedge ratio is 1.02. The value of the future, this is very important. The value of the futures contract will be the 18,000, that is the current Nifty level, into the lot size. Lot size is 50. So 9 lakh per contract is the total money which you have to pay. Now the number of contracts you have to short n will be equal to 50, because your portfolio value is 50 lakh and the coefficient of correlation between them is less. That is, portfolio is more volatile compared to the futures. So you have to short 56.67 or approximately 57 contracts of the future in order to hedge your portfolio. Let us say what is the impact of daily settlement. Future contract as is always settled as mark to market. every day the future contracts are going to be settled. If you if the closure price is today's closure price is less than the yesterday's closure price, if you have taken a long position, you will be at a loss, and that much money will be taken out from your account. And if the yesterday's closing price is less than today's closing price, then if you have taken a long position, that much amount of money will be credited to your futures account. So gains are credited and losses are debited to traders margin account. See, we should understand that the futures and forward contracts, they have similar payoffs at expiration, because in forward contract you will make the payment only at the end of the termination of the contract, whereas in future contract, every day the future gains or losses are marked to the market. So what happens? Every day, daily settlement will result in cash inflow and cash outflow, and this will have direct impact on the margin requirement, which you may have, which has been set by the National Stock Exchange. What should be the margin requirement? So if you are losing continuously, additional margin requirements may be called. Now, how does the daily settlement works? See, usually at the end of the day, the valuation is done at the market close. The exchange will determine the official settlement price. All open positions are marked to this price regardless of actual entry price. Whatever your entry price is there, that is immaterial. So today's closing price and yesterday's closing price difference, plus or minus, will be credited or deducted from your account respectively. This we have already explained. I'll just show it to you. So daily profit and loss is nothing but settlement price minus previous day settlement price into contract multiplier, whatever is the contract multiplier which is there, into the number of contract. That is, if the number of contracts taken is 100, contract multiplier is 50, and whatever the difference which is happening in the futures. Yesterday future was at 22,000, today it becomes at 21,000. So there is a difference of 1,000. So 1,000 into 50 into 100 will be deducted from your account accordingly. So profits are credited to margin accounts and it can be withdrawn subject to maintaining required margin. And losses are debited. It's a very common sense. Now coming to position reset, what does it mean? So after settlement, positions are effectively reset to the new settlement price. That is, next day's profit and loss is calculated from today's settlement price, not the original entry price. That is what I have explained. Today's closing price and yesterday's closing price will be considered. It will not be today's closing price and the entry price. That will not be considered. Now coming for long dated hedges, the difference between futures and forward contract becomes more significant. Why? It becomes more significant because of the cost of carry. Okay, because of this cost of carry, or in case of financial contract, if there is any interest rate changes or any policy changes by the Reserve Bank of India or by the government, it is going to affect the futures and forward price difference. See, in case of future contract, the National Stock Exchange set the minimum amount you should be holding in your account to maintain a particular, contract. So, if the value of that money in your account goes below a particular margin, margin value, then the National Stock Exchange may ask you for additional margin. So, liquidity requirements will be very high in case you are trading actively in the future contract. So what are the practical consideration? All these theoretical differences, for most practical hedging situations, daily settlement impact is very minimal. Why it is minimal? Because at the end of the contract, the future price will converge to the spot price. Okay, so the liquidity and standardization benefits of futures typically outweigh the daily settlement complication. It means you are taking a future position for a particular reason, for hedging your portfolio. So daily profit or gains or losses should not affect your main objective of uh, portfolio management and hedging your portfolio using the futures contract. Now coming to the equity portfolio hedging using index futures, it will protect you against any market declines. Uh, also, it will also help you to hold your stock position. In case if you are not hedged, See, any variation or loss in the portfolio, people tend to exit the market. Or, but that is not the way big portfolio investors look at it. They will hold the portfolio and they hedge that portfolio using the future contract. So the short-term negative outlook of the market is taken care of by shorting the future contract, whereas the main portfolio, if the portfolio manager is sure that the stocks which he has selected is going to outperform the market in the longer run, then the portfolio will still be held, and short-term volatility is taken care of by using the future contract. Now, the hedging approach depends upon whether the portfolio exactly mirrors the index or it consists of actively selected stocks. Actively selected stock will have more alpha. It means the volatility of actively selected stock will be higher than the index stocks. So, as a result, if the portfolio manager has selected any stocks which is not part of the index or which is more than what is there in the index, in such cases the hedging, that is the number of contracts to be hedged, and the minimum variance hedge ratio will drastically differ. That we will discuss in our future slide. So when you are hedging a portfolio which mirrors the index, in such cases the hedging will be usually equal to 1:1 hedging. Okay, but whereas here the number of contracts which is needed is nothing but the value of the portfolio divided by the futures price into contract multiplier, which we have already discussed. Let us take an example. So if the portfolio value is this, it is somewhere around 1 crore, and the future contract value is 9,10,000, and the Nifty future price is 18,000 and contract multiplier is 50. So the number of contracts to be hedged will be 109. Matlab you can take it as 110. So the short positions to be taken in the index future is equal to 110. So this is 1:1 hedging. You are just since the portfolio is mirroring the index, it is the coefficient of correlation will be 1. They are perfectly correlated. It is assumed. So as a result of which there will be a perfect hedge of 110 will be a perfect hedge. But let us assume when the portfolio does not mirror the index at all. If the portfolio consists of certain stocks which are much more volatile than which is already there in the index, it means if the portfolio has stocks which is not mirroring the index, in such cases, the concept which is used is known as beta. So beta is calculated using the capital asset pricing model to hedge the portfolio. We will not go into the detail of capital asset pricing model and beta. Beta is nothing but beta reflects the market risk. It will not consider the alpha. It will consider only the beta. Beta is nothing but the market risk. Okay. Now beta is adjusted and that will be used as the hedged formula instead of using that original formula of minimum variance hedge ratio. So here the number of contracts to be shorted in order to manage your portfolio or hedge your portfolio is beta into portfolio value divided by future price into the contract multiplier. Now the beta is the portfolio beta measured against the index. See, beta generally represents the portfolio sensitivity to index movements. A beta of 1.5 means the portfolio means 1.5% for every 1% move in the index, whether up or down. And a beta of 0.8 means it moves only 0.8% for every 1% move in the index. So 1.5% of beta indicates highly volatile portfolio, whereas 0.8% of beta indicates the portfolio is less volatile than the index itself. Let us say an actively managed portfolio of technology stock is worth 75 million and it has got a beta of 1.35. So given the portfolio value and the Nifty 50 values at 18, Nifty futures price at 1850 and the contract size is 50. So the number of contracts required to hedge this portfolio is 1.35 into 75 divided by 18,500 into 50, which is nothing but 109.46 contracts. That is approximately 110 contracts are required to be hedged. To approximately 110 contracts are required to be shorted in order to hedge this portfolio. So if the Nifty falls 3% here, the hedge actually neutralizes market risk while leaving the alpha exposures. Okay. Any alpha exposure will not be taken care of. It will only take care of the market risk. So if Nifty falls 3%, the portfolio will fall 4.05%. So the portfolio loss will be 75 million into 4.05, that is 3.04 million, whereas the future gain in 109 contract is 9,25,000 into 3% of it, because if Nifty falls 3%, you have taken a short position in the Nifty index, so you will gain 3.03 million. See, it is almost the same. Why should we hedge an equity portfolio? Very simple. In order to take care of the temporary market protection, and in order to ensure that your portfolio in which you have conviction is maintained and it is not sold unnecessarily, and there is not much change in the portfolio. Okay. Secondly, you have to preserve your stock selection alpha. See, there are certain portfolio managers who are confident in individual stock picks, but they are very uncertain about overall market direction. So they can generally hedge the market risk and ensure that they were these alpha stocks which they have selected will perform well. So this will isolate alpha, that is the stock selection skill, from the beta, which is the market exposures. See, alpha, beta, and all you will come to know only if you have studied investment analysis and portfolio management in detail, because there all these concepts of alpha, beta, capital asset pricing model, they'll all be discussed there. See, hedging a portfolio will help you maintain investment discipline, and regulatory or mandatory compliance will also be there. Some of the very huge funds and hedge funds, they mandate requiring minimum equity exposure, but they may want a temporary risk reduction. So in such cases, the minimum equity exposures will be taken care through the hedging by using the futures contract. So hedging will help to comply with the investment guidelines while adjusting the risk profile of the particular portfolio. Hedging a portfolio will also help you to lock in a set of gains which you have already attained in your portfolio. Suppose you have already achieved 20% gains in your portfolio, and if the market becomes very volatile because of geopolitical risk, in such cases you can use this hedging to lock in the gains which you have already done in your active portfolio. Now coming to the changing of the portfolio beta. See, portfolio manager can use index futures. They not only to hedge but to actively adjust their portfolio market exposure without trading the underlying stocks. So they need not trade the underlying stocks, but they can use the futures market to help hedge their positions and actively manage their portfolio. See, by adding or removing future position, managers can increase or decrease the portfolio beta to any desired target level. Suppose if somebody wants higher beta or lower beta, the change in the beta can be portfolio volatility can be achieved by adding future contract or reducing the futures contract accordingly. So what should be the formula for changing the beta? To change the beta, a very simple same formula, that is uh, number of contracts to be hedged for any change in your beta is the if your target beta minus current beta into portfolio value divided by future price into the contract multiplier. If the target beta is greater than the current beta, what are you going to do? It is very simple. You are trying to increase the beta. You are trying to increase the risk in the portfolio. In such cases, you buy future contract. You increase your market exposure. If the target beta is less than the current beta, you will sell futures because you want to decrease your market exposure. And if the beta target is equal to 0, you will do the full hedge and you eliminate the market exposure. And if the beta target is 1, you have to adjust to the market beta. So uh, let us take one example of beta adjustment. So let us take a portfolio value of 50 million. Current beta is 0.9. So they want to increase the beta. So they want to give more exposure to the market risk. So the Nifty future is trading at 18,000 and the multiplier is 50. So how does the number of contracts will be calculated? It is target beta, that is 1.2. So you want to increase your market exposure. That is why the beta is higher than the present beta. That is 1.2 minus 0.9 into the portfolio value divided by the Nifty value. Nifty value is nothing but Nifty futures into the contract multiplier, which will give you 16.67. So you need to buy 17 future contract to increase the market exposure. This synthetically adds aggressive market. See, instead of buying stocks, what you are doing is you are buying futures contract. That's all. And how does it help? Because future contract is basically, you are not paying the full amount. You will pay only a fraction of the amount for that total portfolio notional value, which for 16.67 contract value. For the notional value, you pay only for 30 to 40% of that value, so that you will get the exposure also and you will pay less also. Let us take another example for the reduction in the beta. Here, the portfolio manager wants to reduce the beta from 1.4 to 1. So he wants less market exposure. So accordingly, he has to, short 34 contracts. So he will sell 34 future contract to reduce the portfolio aggressiveness. It means his portfolio has got stocks which are very aggressive. So he wants to reduce that, aggressive portfolio. How does it do? He will short the future contract less than the present beta of the portfolio. See, we should understand the logic behind this beta modification. A portfolio's total return basically comes from the market return, that is the beta exposure, and stock specific return, that is alpha. I have already explained this. So by adding futures, we are essentially adding pure market exposure to the portfolio, that is beta is equal to 1. So each future contract worth rupees V adds market exposure equivalent to rupees V of index holdings with a beta of 1, because market beta is always considered equivalent to 1. Market risk is always considered equivalent to 1. So by buying or selling the appropriate number of contracts, what are we doing? We are adjusting the weighted average beta of the combined position. That is the position of the stocks plus the position of the futures. That is the beta of the stock plus the weighted average beta of the stock plus weighted average beta of the futures will give you our target level. You can use futures for rebalancing efficiency to maintain a desired beta, which we have already discussed